Hey there, everyone. Ryan Schul with Straight Data Science. So, in the topic today, I want to talk about how to backtest a strategy called portfolio optimization and see if we can beat the S&P 500. Okay, so the S&P 500 is an index that has about 500 stocks. It's not exactly 500, but it's pretty close. And this is basically a very good benchmark to measure your returns from your portfolio to see if you're making money or not. If you make money in the stock market and your return for 1 year is 10% good, or is that not good? Like I have no idea. If the market overall was down, if the S&P was down 20% and you're making 10%, you're doing fine, my friend. You're doing totally fantastic. If the market was up 20% and you're up 10%, you're not doing very good, right? You could just invest in the S&P 500 and you can make more money, right? So you're doing a lot of work managing your portfolio and getting behind your strategy and executing your strategy, but you're still coming up short compared to the S&P 500 if that's 20% and you're 10%. But again, it's all relative. If you're 10% and the market is down 10%, you're doing great, right? So you need some kind of benchmark for your performance, some kind of comparison or some kind of like how am I doing relative to others, right? So I have my channel pulled up here. I did a few videos. This is about 2 months ago. How to train AI agents to analyze prices over time and do pairs trading. Here's one: how to train an AI agent to do momentum-based trading. How to train an AI agent to do adaptive learning trading using PPO and DQN. How to train an agent to do trading based on moving averages and relative strength index. How to train an AI agent to do trading based on reward shaping and Sharpe ratio. I'll discuss that in just a minute. And how to train an AI agent to do trading based on support resistance signals. So there's 6 videos I did all in this series, all about 2 months ago. You can go check that out if you want. Very interesting, but I'll tell you truthfully, every single time in those 6 scenarios, the S&P 500 beat the trading strategy. And these are very popular trading strategies that people get behind and they're like, I'm gonna make a lot of money, I'm gonna do this, I'm gonna do that, I'm gonna do all these things. But I'll tell you truthfully, hedge funds go out of business all the time, right? There's Melvin Capital that had a big issue with, what was that, GameStop a couple of years ago. Long-term capital management, it's kind of ironic that long-term capital management has long-term in the name, and it wasn't around very long. It was around for, I think, 3 years or so. You can look that up. That was very interesting. I love the history of finance. There's a couple books I have. It's just fascinating. Lehman Brothers and Bear Stearns, all these guys are larger than life. We're going to do this and that and all these things, and then they just collapse in the blink of an eye. I think, I think it's sad, but I think it's hilarious too. But we don't want to go down that path, right? That's hubris, that's pride, and there's a lot of greed there too, right? I'm trying to promote intelligence and knowledge. That's what I try to do on my channel, right? It's not about greed. It's not about wealth. You will fail every time if you follow that path. If you follow the path of wisdom and knowledge, intelligence, you will prevail. Okay, so that's what this video is about. So, given all of the multiple investment outcomes and all the options, how can we allocate our capital and make the best investments and maximize the returns, but at the same time, try to minimize the risk? Or there's always a trade off, right? You can't maximize your returns and minimize your risk. That just doesn't exist. That's mathematically impossible. That is, you can't do that, right? That doesn't work. But you can maximize your returns and take on more risk, or you can minimize your risk and accept lower returns, right? There's 2 outcomes right here. So we'll try to maximize risk-adjusted returns. We do adjust for risk and we try to maximize returns, but we can't do both at the same time. We try to diversify our money into different investments, right? If you concentrate all your wealth into one thing and that works out, that's good for you, but that's called gambling, right? That's not investing. You want to kind of spread your money around a little bit. We want to control for risk exposures, make our capital very efficient and very liquid, and how we move in and out of these different stocks is going to help us achieve our goal of higher returns, right? And balance the return goals with capital gains. So I have this exact code in one of my other videos about portfolio optimization. We're going to import some data from Yahoo Finance. Okay, so this library here is very important. These are the tickers. I'm going to go back in time 3 months. Okay, so 3 years. 36 months is 3 years. And we are going to loop through all these tickers. This is the loop right here for ticker and tickers. Tickers is right here. That is the list of tickers. These are all the stock symbols right here. I'm going to download this in this historical stock data, and we're going to define the portfolio. These are called user-defined functions. This is the portfolio annualized performance. We're looking at the weights of each stock, the mean returns, and the covariance matrix. Covariance is like how these stocks covary together, or how the stock prices move together. I have that right here. This is a covariance matrix. The number of portfolios is 10,000, so we're going to do 10,000 simulations. And the risk-free rate I set at 2.78%. I think that's pretty relevant in our interest rate environment right now. It's mid-May 2025. I think that's really relevant. So here's another user-defined function that we're going to lean on. We have the weights of each stock. I'm looking for the mean returns, the covariance matrix again, the risk-free rate, and then the lambda, which is a magic function in the Python world, right? Looking at the maximum Sharpe ratio. So again, so we can maximize the Sharpe ratio. The Sharpe is the actual return minus the risk-free rate divided by the standard deviation. So the higher the standard deviation, the lower the Sharpe ratio, right? But if you can minimize the standard deviation, which is the variance, that's the choppiness or the movement of the stock over time, right? So the lower, more consistent, more persistent, that's what you want. You don't want a lot of bounciness and movement over time that's catastrophic. It causes a lot of anxiety and a lot of uncertainty. You don't want that, right? You want to go to bed at night and sleep well at night. You don't want to go to bed and think, like, what's going to happen with my portfolio tomorrow? You want to maximize, you want to minimize the standard deviation or the variance and the movement of your stock prices, right? Like you can't really control that, but I mean artificially, that's what you're trying to do. So minimize the variance of the portfolio. That's the mean return and the covariance matrix. We will also create a function for portfolio volatility. This includes the weights and the mean returns. And let me just kick this off because this does take a couple of minutes to run. It's running now. Yeah, it's running. I see the hourglass. Okay. So we have that. We have the efficient returns. So this basically is the mean returns, the covariance matrix, and the target variable that we set. And we have certain constraints too, okay, and the bounds. So the bounds for this whole optimization process, remember, we're trying to maximize returns and minimize the risk of the portfolio. You can do one or the other. You can't do both at the same time, but we can see two scenarios with the maximum return and with the minimized risk, and we can pick, okay, I want to invest in these stocks because this is going to give me a better return, or I want less risk exposure, so I'm going to invest in this portfolio over here. So we're going to get two portfolios, and the condition here, or the constraint, or the guardrail, whatever you want to call it, is 0.25. So we're not going to invest any more than 25% into one stock because, again, you have concentration risk. If you have one stock that's really an overachiever and outperforming the rest of it, you can put 50%, 75%, maybe 100% into one stock, but then you have no diversification. And if that stock crashes, then you're done, right? Like if you invested all your money into Bear Stearns in 2008, like you have nothing to show for that, right? You want to allocate and redistribute your wealth and kind of um, delegate over a few different stocks, at least a couple different stocks. You want this diversification. The only way you can consistently make money in a stock market is diversification and dollar cost averaging. Okay, nothing else really works. So I'll show you in a few minutes here the outcome of this model. But the only way that you can potentially make money is diversification and dollar cost averaging. So diversification is investing in a bunch of different stocks. Dollar cost averaging is saying I'm going to invest like whatever it is, $100 or 1,000 or 2,000, whatever, this week, and then the next week, and then the next week, and the next week. And when the stocks go down, when the stock prices go down, you buy more. When the stock prices go up, you buy fewer because you put in the same amount every time. But over time, if the stock price appreciates a little bit, at least a little bit, hopefully, most of these stocks do, some do not, but most of them do, you'll get more and more gains because you've invested the same amount consistently in the same frequency or same cadence, right? So we have the efficient frontier right here. Basically, this is the last UDF. And I'm saying, look at the mean returns, the covariance matrix, and the returns of the range of prices, okay? So everything is consolidated and distilled into these calculations down here. Just ran it. These are the prices. These are the stocks I just pulled back. This is the data frame. And then here is the maximum Sharpe ratio portfolio allocation. So the annualized return is 27.8%. So 27%. So pretty good, right? If you invest $1,000, you'll make $278. If you invest 10,000, you make $2,708, $80, I guess. And this is the annualized volatility, and this is the Sharpe ratio, right? So anything above one is good. Close to one is okay. Higher the better, right? You want your Sharpe ratio to be higher. So the Sharpe, again, is the return minus the risk-free rate divided by the standard deviation, and that is the volatility or the bounciness of the stock. So this is a maximum return 2.78. If you go down here, you have a lower return 0.097, so quite a bit lower. You have 27% here. This is 9%, okay? But the volatility is 0.118, and here's 0.155, so quite a bit lower volatility. And of course, the Sharpe ratio is lower, 0.58. You want that to be about 1 or greater than 1. And again, it shows you the allocation for each stock. So Apple, you should have invested 0. Microsoft, 8%, 8.13% of your portfolio. JP Morgan should have 23%. These are zeros over here. No, the Verizon, oh no, this is Visa, 1.71. CRM, I'm not sure what that is. I think Salesforce. This is McDonald's. These over here are all zeros. Okay, so don't invest anything in these. And your only other investment over here is TRV. So the biggest investment is JP Morgan for the highest payoff, the most bang for the buck here with an annualized return of 2.78. Okay, so hopefully that makes sense. And then you have down here annualized return and annualized volatility. So everything is printed out over here, and this is the data frame. Okay, so here's the return, and again, the volatility with each stock. All right, okay, so hopefully that makes sense. If not, and this is the allocation down here. So Walmart, 25%, IBM, JP Morgan, 23%. So these two, so this totals up to about 100%. If I copy and paste that into Excel, it should be about 100%. Let me do that real quick. Might be a rounding error, but I bet it's going to be pretty darn close. And then this is the allocation for the minimum variance, right? So remember, there's always two things. You can maximize your return or minimize your variance. You can't do both at the same time. There's always a trade-off. There's always a trade-off. Can't do both. Okay, so my Excel is opening. I think this computer is getting a little bit old, like me. And put this over here. Okay, paste it. And if I do this, I have down here 100%. See where my mouse is, sum 100%. So yep, adds up to 100%. And this should be exactly the same, J&J. You can see here the allocations are slightly different, right? Because that is the minimum return. It's not the maximized minimum. That is a minimum variance, not the maximized return. If I go down here, sum is 100%. Perfect. Okay. So we got it. So mission accomplished. We got that. But here's the whole point of the thing. What if we can do this and backtest this whole philosophy of portfolio management and then try to beat the S&P 500, right? So that is my goal. So I know historically, backward looking, which investments I should be in, right, to either minimize my volatility and still make a decent return, right? These are the stocks I should have picked. And if I want to maximize return, right, but have a higher volatility or higher uncertainty, higher standard deviation, these are the stocks I would have picked. But let's see if we can do this on a monthly cadence going back in time. This is date range 2022. Okay, so it goes back 2025, goes back about 3 years. That's fine, about 3 years. Control Enter to run this. So let's see what the outcome is. Again, we're doing simulations. I'm sorry, this is not simulation. I was thinking of another video. This is $10,000, $100,000 invested. Let me see what the outcome is going to be. Okay, I'll share all this code with you. So the maximum Sharpe for each of these stocks is presented right here in equal weights. This is the weight, because we're putting in the same weight for each of these 30 stocks. I think there's 30 here. I'm doing the Dow 30, maybe it's 29. I kind of copied it offline. I didn't really pay attention. How many do we have here? Okay. Oh, it's only 21. That's fine. That's fine. So it illustrates the point. The Dow 30 would have 30 stocks. I'm just looking at 21. I was playing around with the code. I probably cut some out for whatever reason. So you can see the maximum Sharpe and the minimum volatility, and then equal weighting for each one, right? Because we put about 4.7% of the portfolio into all these stocks and just spread out evenly across all these stocks. So that's what the point of that is. So let me go down here, and we were going to look back. In this case, 120 months. So divide by 10, divide by 12, that's 10 years. So we're going back 10 years in time. Let me run this. And the code is very similar to what we saw above. I'm not going to take you through all the details. I will share all this code with you. I'll give all this to you, right? So you can copy and paste it and run it for yourself. I don't want to be redundant and reiterate everything that's already been done here, but the code is essentially the same. But the difference here is that we're looking at the total, we're looking only at the total return, the annualized volatility, and the Sharpe ratio. So the Sharpe ratio is very important in the portfolio management world because we're looking at the actual return that we get on this portfolio, these investments that we make at the end of some specific period of time, whatever it is. Usually it's a year, it could be a couple of years, it could be half a year. It's whatever you decide arbitrarily. Usually it's a year though. What did you actually achieve minus the risk-free rate, because it's a cost for doing business, right? You have to borrow some money and you have to have some transactions with a bank. Usually money is not free. And then you divide by the standard deviation or the choppiness or the volatility of that stock over time. That's what we're looking at. So we have the trading over here, the actual trading activity. So what should we have bought, which stock, and what is the action, buy or sell, and at what price? Because we know those historical prices in the past and how many shares, and then what's the cash balance that the portfolio has at that point in time. Okay, so let me refresh this. And we'll see based on the date, the ticker, the action, was it buy or sell, and the price that we bought or sold at, and the number of shares that we bought and sold, and then the actual cash balance. So we're basically setting up almost like an AI agent. I showed you over here before. These were actual AI agents over here. So these are artificial agents that I trained and tested. These 6 right here. I showed you that before, how to train an AI agent. 1, 2, 3, 4, 5, 6. So I did 6 videos on that. And this strategy, you'll see in just a bit. I don't want to do a spoiler alert, but you'll see what the outcome is. This is actually the best that I've seen so far, and I've tested many, many, many different scenarios, and I've posted most of my results here on YouTube. So you see the date, the ticker, the action is a buy or a sell, and then the price at that point in time, right? We're going back in time. This is history. What should have been done based on the efficiency and the optimization of this whole process? What should we have done at that point in time to achieve the best returns that we could on this portfolio, right? So this shows us step by step what to do. I'm just looking at the head and at the tail. This by default shows 5. If you put some other number in there, like 100 or whatever, I'll show you the top 100 or the bottom 100. And if you take this out like that, it shows you everything, right? So dot tail, just leave that like that. I just want to look at the top and the bottom just to make sure, like as a sanity check, that everything is basically working. Okay, so let me go down here. That is fine. Everything lines up. Everything meets my expectations. I want to look at a momentum score. This is the momentum to determine which stocks are better. So higher is better. So here the Dow is better. Disney, Amazon, and that's Amgen. CRM, I think that's Salesforce. CVX, I'm not even sure what that is. This is Procter & Gamble, JP Morgan, Apple, Amazon. So over here, lower is better. So you want higher momentum. You want the stock always going up, right? Monotonic, which is constantly increasing, is great. In the real world, stocks are not monotonic at all, right? They go up and down, they bounce all over the place. But the more monotonic you can get it, the better off you're going to be, the more money you're going to make. And you want a lower standard deviation or lower volatility. So here, the better numbers are at the top. This is less volatility. This is actually higher volatility. So this is interesting. JP Morgan has higher volatility, JPM, and over here has higher momentum too. So I think it kind of makes sense, right? Like it's kind of going up most of the time, but it's kind of choppy and it's bouncing around a little bit. That's why you get the volatility, but the returns and the momentum is pretty decent. So that's something that I would definitely consider for my portfolio. So now we have to do a baseline comparison, right? So we need something to compare this whole scenario to. So if I'm making, I think I said it right, if I make 10% return, is that good or not? I have no idea. If the market is down 20% and you make 10%, that's great. That's fantastic. If the market is up 20% and you make 10%, that's not very good. Like you're missing out. You could just invest in the S&P. So we need some kind of baseline comparison for our analysis. So I'm going to bring in the S&P and look at the total returns for the S&P. Okay, we have a total return of 2.2 and the Sharpe ratio is 0.81. So higher is better. We'd like to see 1.0 or higher. This is okay, but it's a little bit low, 2.20. And this over here was 3.03. So in this case, and the Sharpe ratio, you can see it's 2.2, right? So anything over 1 is good. So in this total return, 3.3 definitely beats the S&P 500. If I plot it, you can see the results down here. Control Enter. And let's look at the plot over here. So your portfolio is in blue and it's mostly monotonic, it's mostly increasing. This is definitely the best strategy I've seen. When I looked at these others over here, I have 6 other videos on my channel about training AI agents. So you can train an AI agent to do a lot of different things, but is it going to outperform the market? In six different strategies I tested, 6 fundamental proven strategies on Wall Street. None of them worked. The S&P always came up ahead of these other strategies. So strategy came up short every single time. This is the only one I've seen that actually beat the S&P, right? So we actually beat it. But let me show you a little trick here. It actually depends on the time frame that you're looking at too. So if you go back here, where was it? Oh, that was the original one. Sorry, let me scroll down here. If you go back here, I think that was a little bit different. Yeah, this is a look back months. So a lot of it has to do with these two um, features right here. So the look back months is the number of months you're going back, and the momentum months is the number of months less than the look back months that we're actually doing the analysis on. Okay, so you have to adjust these and fiddle around with it, and it's a little bit manual. It's a little bit like kind of guesswork. But if you set this to 6 and 6, let me run this. Look at this. This is very important. Okay, I want you to see this 3.03. So the total return is 300%, basically 300%. If I just change that from what was it, 18 and 12 to what's the new one? 6 and 6. Okay, so let me change that and rerun the analysis. This is very, very important here. Okay, and let's see what the outcome is. So essentially, you have to be in the right place at the right time to make money. So if you're looking back 18 months and you're doing the analysis for 12 months, this strategy makes money at 300% return, which blows away the S&P 500, which came in at 220% return, right? So let me go back here, go up a little bit, and see what the result is. So you kind of have to play around with this a little bit, and it is a little bit manual. I'm sorry for that. That's just the way it is. Or you can put that into a list and you can go through different iterations and see what that is. I didn't even bother to get into that. This is already complex enough. Like I don't want to like overwhelm people here, but well, let's see what the outcome is here. And this is very important. It's like basically being in the right place at the right time. If you do the analysis for shorter duration of time or longer duration of time, it does make a difference, right? So I'm not changing any of the stocks. I'm not changing the analysis. I'm not changing any logic. I'm just changing the look back period and how far we're going back for the analysis and then how we do the analysis after that. So let's see, it should spit out an answer pretty soon. I still see the hourglass running up here in the left-hand corner. It's pretty quick though. But that is the key to this whole thing right here. So I will leave it up to you to decide what is the best look back months and the momentum months. So we're looking back in time and going forward at the same time, right? That's what the momentum is. So it's a little bit arbitrary, 2.06. So now we have 2.06. So we went from 3.3 to 2.06, right? So depending how far back you go in time and how forward you look in time, this is going to impact your total returns. And of course, your Sharpe ratio, which is tightly coupled with the total returns, it's integrated. You can't even like decouple those. So um, that's it. That's the only gotcha. That's the only pitfall. And if I rerun the chart here, let me see what this thing looks like. Cool. Still beating the S&P 500, but I mean, you have to be careful of that, right? So that is the main thing to look out for. And all this code, I know it's a little bit complicated. It's a little bit overwhelming. I get it. I understand that. It took me a long time to put this together, so I understand. Where is it? I can't see it right now. No, it's down here. Oh yeah, that's the 2.02. So the main part of this code to focus on right here is that, and of course you can put in any tickers you want, anything on Yahoo Finance, but to look back and look forward right here is critical because that is going to determine, again, how far you go back, how far you look forward in the number of momentum months forward looking, and the return. Are you going to get 200%? And again, this is 10 years. So 200% 10 years is not bad. It's not it's not huge, but it's not bad, right? You've doubled your money, but you've invested your money for 10 years. That's a good chunk of time of your life. Um, so you definitely made money, right? It's not like you made nothing, and it's not like you're losing money. So it's still a worthwhile investment. But do you want to make 200% or do you want to make 300%? It really depends on this right here. These two lines of code are very critical for this entire analysis type of analysis right here. Let me let this go and sit on this for just 1 minute and see how things work out. I think we're going to be back to the 300% after this. But I think this analysis is pretty interesting and very sensitive to the inputs and to um, what type of time frame you're looking at. Are we looking 1.8? Oh, that's interesting. So 1.8%. So let me look at this thing here. Do I go back? Do I go back 9 months or what? Control Enter. So you can see right here is kind of arbitrary, right? Like how far back you look for the analysis and then how far forward you go into the future um, to do all these calculations right here, right? So let's let's just let this simmer for a minute or two and see what the outcome is. But that's it in a nutshell. Like those features will change depending on how comfortable you are with the look back and the look forward, and then of course you can change any of these tickers symbols right here. You can change all of that and make it whatever you want. Right, it's totally up to you. But I think overall the analysis is very interesting, and of all of these 6 other strategies I tested, this is the only one that actually beat the S&P 500. And I think the reason for that is because if you're in the S&P 500, essentially 1.95. Okay, so it's a little bit different. So the S&P 500 is the broad index, right? And if you invest in that, I think I heard some statistic that sounds a little bit weird, but I think it makes sense. If you miss, if you are in the S&P 500 for 1 year and you have 5 big trading days, you can make a lot of money. If you somehow miss those 5 trading days, you're going to make nothing. So most of the returns from the S&P 500 on average, like not every single year, but on average in 1 year, come from 5 big days of returns, right? Like the market could be up 1,000 points or 1,500, maybe 2,000 points. That's a big move. But if you're somehow out of the market for 5 days, you miss all of that and everything else is irrelevant, right? So those 5 days are really critical for all of your returns, right? So everything comes from that. So the S&P a lot of times is going to outperform most investment strategies. And I prove that if you go to my channel and you watch these 6 videos over here. Was it how to train AI agents to do prices, pairs trading and momentum-based trading and adaptive learning and what else? Averages and relative strength and shape, reward shaping and Sharpe ratio and resilience signal. If you look at those 6, I think it's very interesting and very informative. But this is the only strategy that beat the S&P 500 and all of my analysis. So it's kind of crazy, but that's a truth right there. So just because a stock scores well on momentum and volatility today doesn't mean it will outperform in the future. So these are always backward looking, right? We can't predict into the future what's going to happen next. And this is not investment advice. Please don't try to sue me or whatever. I've been out of work for 18 months. That's why I came to YouTube and started creating videos. I couldn't find a job and got rejected from hundreds of job offers, even though I went through all the interviews and all that. So I have no money, so I can't really be sued. I can't give you any money. So this is not investment advice. This is just statistics and mathematics and pure finance. And this is how this stuff works. I'm not telling you or giving you recommendations or whatever. I'm just telling you mathematically how everything works out. Okay, this is the truth. So it's not investment advice, but the scoring is based on past returns and past volatility. And it's always backward looking. We can't take this and project that into the future and have absolute certainty about the outcome. It just doesn't work like that. Like I wish it did. Everybody would be a multi-trillionaire if it worked like that, right? But it doesn't. We know what happens in the past. We know that what happens in the past probably could continue into the future, but there's no guarantee of that, right? And what drives total returns is based on future performance, which and mostly deviates, right? It doesn't stay the same. Everything changes. The only thing that is constant is change, right? I'm sure you've heard that before. And the stocks that were the best may not continue to be the best, but at least this gives us a good roadmap and a good guideline to follow and removes a lot of the emotion for making investments. Like I used to have a lot of emotion when I was younger in my early career. I was falling in love with stocks. Oh, I love this stock. I love that stock. I love all these stocks over here. The stock will never love you back. I can guarantee you 100% the stock will not love you back. So do not fall in love with that stock, okay? Because it's not going to love you back. Remove the emotion. This is just based on math, stats, computer science, data science, finance. That's it, okay? That's literally, I think when you get the emotion out of the way, you can make more intelligent, more informed decisions. And I think that will enhance your investment performance, okay? And as a backup here, I have some notes. This is another way to get stock data. I had some problems with the Yahoo API. A couple of weeks ago, I tried to put this video together like maybe 2 or 3 weeks ago, or whatever, and had some issues with the Yahoo API. Kept saying like too many hits or whatever. Like it kept timing out and giving me errors and everything. So if the Yahoo API is not working, I found this. I did a little research and did some Googling. This is a nice substitute for the Yahoo API. Hopefully they don't continue to have issues, but when I started working on this video about 2 or 3 weeks ago, there was some massive issues. I couldn't do anything with this thing. So it kind of like just stalled on me and just seized up. But finally, the API started working again, so I was able to put together the rest of the code and finish this off. So that's it. I'm going to wrap it up here, guys. This was a little bit on the long side. I understand that. I get it. But I think this was informative. I think I was able to drop some knowledge and some information. And again, this is the only strategy out of those 7. Now, this will be the 7th strategy, but I did 6 before. And the other 6, the strategies always came up short. Nothing can beat the S&P 500 as an investment vehicle. But this one actually did beat it. So that's why I wanted to put the video together and push it out to you and just share my findings with you. Okay, so I'm going to wrap it up. Thanks for your time today. Thanks for checking in and watching right through the whole end of this whole process. I appreciate that. And I will see you in the next video. Take care for now. Bye.